and welcome, and thank you for tuning in. You're watching the UTI Swatantra series powered by ET Now. This is our ongoing endeavor to make sure that all of you understand how investments function and you can use them to build a portfolio that makes you very, very rich over the long term. Now remember, if you have any questions that you'd like to ask us, you can reach us on our website, indiainvestkaro.com, or you can tweet out your question, #InvestKaro. We have a wonderful audience in the studio, and these are all public service officers, so they're here to ask us questions. We're going to find out how investment planning is different for them when it comes to just planning out their investments, in comparison to the rest of us who work for the private sector or who are self-employed. And I have two wonderful guests in the studio with me who are going to help me answer those questions. And I'm going to start an introduction. Ladies first. Renuka Jain is an investment and wealth management advisor. And Sanjay Sondhi is a founder and managing director at Pegasus Advisory Private Limited. Thank you, both of you, for coming in. When we normally answer questions that come in from people who work for the government, state or central, one of the biggest difference for a government employee vis-a-vis the rest of us is insurance. The fact that health insurance gets taken care of, and I think that's a massive, massive part of, of financial planning altogether. But in your experience, and I'll start with Sanjay, in your experience, how else is financial planning for a government servant different from the rest of us?
So as you rightly said, the health insurance gets taken care of, and most of the employees, particularly people who were employed before the NPS came, were onto very healthy, pension funds, or they were into gratuity schemes, or they were government schemes which took care of it. Because their tenure is more stable than, let's say, an employee from the private sector, in fact, their appetite for risk is more, because they don't have that fear of losing a job. So I deal with a lot of people, let's say, from Ministry of Defense, and these people, they are transferred all over the country, and they feel they've been left out of the action which is happening in the metros. So in fact, they want to invest more in equities, and because they feel their job is more secure. So their risk appetite is more, but you need to inform them about the risks which are there, and once they're on, they take very easily to equity.
Narendra, tell me this, if my insurance needs are taken care of, and I have a slightly higher appetite for equity at this point, what would you say would be top priority for all public servants to keep in mind when they're starting an investment or maybe starting to build a portfolio?
See, basically, I feel the major difference between a private sector and a public sector is a perception. As he rightly said, public sector guy is slightly more, risk averse. He would not want to take risks because he has seen security. So his mindset is like that he wants to see security. But the major play is that, they rely too much on their retirement earnings or whatever, but they don't give consideration to the inflation factor. They feel, okay, this is the corpus that they're going to get after retirement. But, it's as simple as, if today, they are buying something for 10,000 rupees, they might be spending 17,000 on the same thing after 10 years. So, they have to start, they have to see other asset classes also, rather than just relying on their job or just saving or getting into fixed deposit is not going to get them anywhere.
All right. I'm going to open the floor to questions because I know all of you have come in with questions and we want to do justice to everybody who's here. The gentleman in the front, you have a question. Go ahead.
Hi, my name is Narendra. I'm a technocrat. I invest generally in insurance, fixed deposits, recurring deposits, or directly in stocks, or my money is lying with my saving accounts. So why should I invest in MF?
Why should he choose a mutual fund?
Yeah, I can answer that. So today, the mutual fund space is actually one of the best spaces for a retail investor, because you have a trained fund manager who's probably gone to business school, probably an engineer, and at a very, very low cost, he can manage your portfolio. Because, for instance, you've invested in an insurance scheme. Now, insurance is a very expensive cocktail to do an investment, unless you're doing term. But that probably is not the most efficient way to do it. So you need to do an asset allocation. So there would be space for, let's say, insurance in your portfolio. You should have some bank deposits. You could have some liquid funds. So you need space for all of them in the portfolio. You need to construct a portfolio with a plan in end. So you should, let's say, factor in what is the kind of inflation which is there, how many years to retirement. You should actually do like a table of what are your liabilities in the future, your children's education, plug them all in, and then decide how much you want to invest in. For instance, supposing you want to, the rate of interest, let us say on debt securities, let us say 8%, and you have an X amount to invest today, you would know that at 8%, this amount will become, let us say 1 lakh will become, let us say 1,50,000 after, let us say 5 years. Now, if your requirement is more than 150 at that point of time, you will have to change this module. You will have to say, okay, let me go to a product where I can make at least 15%. So this 1 lakh, you'll probably make it 80,000 in debt and 20,000 in an equity product, which at least has an ability to give you 15%. So your combined capital will reach you, if you want to reach 175. But of course, you'll have to take the risk. But if you don't take that risk, you will not get there. So I think mutual fund for the retail investor today makes huge amount of sense. SEBI, this is the only product where, SEBI has said that there has to be disclosure of commissions, there has to be disclosure of, there's so much transparency in this product, so that I think the investors have not had such a good product in a long time.
I'm going to go to Renuka about asset allocation a little while, but one other thing that we tend to normally miss out on, so if I buy an insurance policy or a fixed deposit and assume, or a recurring deposit, over a period of time you've accumulated 10 lakh rupees. Now for whatever reason, you need 2 lakh rupees out of that to use for, maybe you have some sort of a need. Insurance policy, a fixed deposit, a recurring deposit, you have to break that investment entirely. In a mutual fund, on the other hand, you can choose to liquidate only 2 lakhs and leave the other 8 lakh rupees to continue to function, which I think is so important when we are planning that kind of liquidity. This is one of the few options you have that will allow you that liquidity. The other thing is he did say he does invest in stocks, but there is an advantage to having somebody else manage your stocks for you vis-a-vis actually having to do it yourself, isn't there?
See, yeah, I'll tell you, if you are investing in stocks, you must be knowing, what is a blue chip, what is a mid cap, right? So in a blue chip, you might have ICICI Bank or, Infosys, Reliance, SAIL, everything. And in a mid cap, you might be having, companies which might become large cap later on. Now, the issue is, there has to be a call. There are times when blue chip will perform better, and there are times when mid cap will perform better. But the issue is, are you so well equipped to know when? If I see today's date, blue chip has underperformed mid cap. But you as an investor would see, okay, mid caps has given a huge performance of say 70% in last 1 year. I should get into mid cap. But actually the time is to get into blue chip, and that is something which is decided by a mutual fund manager because he is so well equipped. Even I am not so well equipped as he is. We are equipped to know those fund managers, and you should be equipped to know an advisor who tells you where to invest and when. That's more important rather than if you catch a disease, right, you go to the doctor, get your test done, everything. So that way it's very important for you to do a planning and just don't go, you go get those tips. Okay, invest in that, invest, and those are the people who lose out.
On that note, we're going to have to take a very quick break, but when we come back, we'll answer more questions from our audience. Remember, if you have a question, #InvestKaro. Send your question to us. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're answering questions from public service officers, helping them plan their finances better. There's a gentleman in the front who has a question. Go ahead.
My name is Virendra Kumar, and I retired from BSNL as Chief Accounts Officer in the month of December 2012. How can I manage my financial investments so that I can get a huge amount, about 5 to 10 lakhs within 3 years? So, either through mutual funds, stocks, or any method.
So is your monthly expenses taken care of? Is there a pension that's paying for your monthly expenses?
Yes, fully expense.
Okay, so you only want to invest for the next 3 to 5 years?
Next 3 to 5 years.
Health insurance, life insurance, everything is
everything.
All right, okay. So that's a very clear goal.
Yeah, so you don't have any liabilities or some expenditure?
No, I have no liability.
Fine, then you need to basically do, you have to again do an asset allocation. Yes. Some amount in equity, some amount of debt. You can't go berserk on one side, one asset quality. You can't go completely into equity. you'll have to look at the level of the market, and here an advisor will actually help you which assets to go overweight on. And just because you want to reach at a very high figure at the end of, let's say, 3 or 5 years, you cannot lose cognizance of the market. You can't say that I just want to go into equity because this gives high return. You have to look at the market level. So to get an adequate return from equity, you have to give yourself time. So 3 years may just be enough for equity, may not be enough. So sometimes what can go wrong in equity, in fact, to continue what she said was there was a research on the BSc that if you hold equity for, let's say, 5 years, the chance of loss goes down by 50%. And if you hold it for more than 10 years, the chance of loss is almost zero. And they've done it across Indian exchanges, the world exchanges have done this study. So 3 years, you cannot be completely into equity. You'll have to have a balance between debt and equity. And then you'll have to see what is the rate of interest prevailing on the debt instruments in the market today. You'll have to see what is the kind of GDP projections which are there for the country. So generally, you will add about 4-5% on the GDP, and you'll have a number by which is realistic for you to expect to reach at the end of 3 years.
The gentleman in the front has a question. Go ahead.
My name is Balkishan Swani. I am already retired from the public sector undertaking. I got lump sum money. So I decided before my retirement, I started investing in the stock, not the trading, only investment for last maybe more than 15 years or something. So when I got the money, lump sum money on the retirement, I put everything on the FD actually. So I wanted the secured one because some investment was already in the stock. So now I wanted everything secured. This one, so I put in the FD. So I wanted to do in the FD is the only thing where I can get secure any other secure. I want the secure thing. Risk I am taking the stock, but secure is the FD. Is there anything else which I can get the assured return?
You know, there are two options for him. One is a mutual fund. The other one is the senior citizen savings scheme, which I think is a brilliant option.
Fund is not the assured one. I want the assured one. FD. Parallel to the FD.
So I want one of them will explain the senior citizen savings scheme, and the other one will explain a mutual fund to you, and we'll tell you why there are better options than a fixed deposit for you.
But
Which one
before
do you
I start on the senior citizen scheme, continue on the FD part, which is, you see, the problem with the FD and senior citizen scheme will be that you're paying tax on this. There are enough schemes available in the mutual fund space where we'll save tax. For instance, you get into an arbitrage fund. There is zero tax over there. There is no dividend distribution tax, long-term tax is zero, and it's almost market neutral fund. You have no market risk. So you have to see your tax situation because senior citizen will give you about 9%, but you have a lock-in of 5 years. Whereas if you go into a fund, there are several funds available which have a debt component and arbitrage component, which means you're free after 1 year, you have liquidity, there is zero DDT, and there is zero capital gain tax after 1 year. If you were to sell before 1 year, you have only 15% tax. So senior citizen scheme is fine, but you have to look at your tax rate also. It's a 5-year scheme, gives you 9% every quarter. You can extend it. But the problem is not liquid if you want, because you see, as you're growing older, you might need the money for some medical emergency, something. Here, if you're in a fund, you can actually get it out by the press of a button. 3 days, 2 days, the fund is with you.
But and in the FD also, anytime I can liquidate this.
Yeah, but you're paying tax on it. So you're paying 30% tax on it.
Tax is there, that's what I'm saying.
If you're just able to save this 30% tax, your yields are going to go up. And with the same amount of risk. So there are lots of products available which will invest only in bank CDs or only in bank FDs. So your risk levels remains the same, but you are enjoying the tax arbitrage and saving on the tax.
But then I will get the assured one.
Almost assured.
Yeah, almost. Yeah.
No, it cannot be assured.
Can you give me the post-dated check? This is the check you will get.
It's
because
not
that
possible.
Type of assurance I want. Because
I mean, obviously there is a risk and return balance.
Yeah, correct.
So normally, say if you take the fixed deposit or the senior citizen savings scheme, it gives you an assured return. But there is a taxation. So there are advantages and disadvantages to every investment. No investment will give you exactly what you want without tax, without any risk. I mean, that's an ideal world, but unfortunately we don't live in an ideal world.
So that's why I decided two parts. No? One is totally assured one with the tax. Another is risk.
We have fixed maturity plans in the market. And most of the HNIs, they prefer FMPs over fixed deposits because, as he said, it's more or less assured because we know what papers they are holding, what is the yield like, As per SEBI, they cannot disclose. But we exactly know that, the yield is going to be 8.5%, 9%. So it's more or less assured. And it's a 3-year product. After 3 years, it's long-term taxed, that too with indexation. So you're actually not paying any tax. and the rate of FMP is always equal to the rate of FD, almost equal. So it's like you are investing at the same rate with an FD or an FMP, but FMP you are not paying any tax, and FD you are paying the entire tax. So FMP is definitely a better option than FD, provided you know what papers FMP is.
Couple of disadvantages of an FMP are fund management fees, which an FD doesn't have, and those 3 years is a hard lock-in. I can't take the money out at all if I choose that I want the money back. So, like I said, there are advantages and disadvantages for all the options. You have to consider, this is where an investment advisor comes in play. It's time for us to take another very quick break, but when we come back, we'll answer more questions from our audience. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. It's a very, very interesting conversation with our audience full of public service officers, some retired, some still in service, but very interesting questions they have. So we're going to get straight to it.
My name is Vinod Sapra and I have been working with central government since 2004. For us, NPS has been made mandatory, and NPS is having tier 1 and tier 2. Two accounts are there. For me, tier 1 is on auto option. So I have not selected any option for that. And looking into the fact that I have more than 20 years left for my service before retirement, should I choose tier 2 account or mutual funds?
I would say move out of the auto. And as you know, tier 1 is a compulsory account and tier 2 is your optional account. But I feel, given the nature in which the NPS system has started off, and they had initial hiccups because of the kind of fee they were paid, the focus was not there. They don't have a huge amount of corpus. I think the government is doing enough to get fund manager attention back over here. But some of the funds have been doing much better. So I would say, as of now, the mutual funds are doing better. But tomorrow, if the government does give incentives, let us say the taxation regime needs to be tweaked over there, the exempt. When it happens, then of course NPS will score high because it's got very low expense ratio. But I think an active fund manager, fund choice would be better for you.
No, till now, performance has been good for tier 1 also.
Right.
Tier 1 has
tier
given
1
good
we're not
performance.
debating because it's compulsory anyways. It's not like you can take that money out. So what you should do is go as high on equity as possible, which is 50%. So come out of the auto function, pick your asset allocation, go 50%. In the alternative, which is tier 2 versus mutual fund, he says mutual fund is a better option.
So
Yeah.
simultaneously, I'm also investing in mutual fund, but I go for lump sum and look for the indicators like drop in Sensex or Nifty. And should I see for other indicators to invest in a mutual fund?
All wrong answers. Yeah, I'll take Redika. Why should we not do lump sum? Why should we not look for indicators if I have 20 years to invest my money?
See, I'll tell you one thing. No one can time the market. If I could time the market, I won't be giving a financial advice. I would have been a millionaire. So no one can time a market. SIP looks like the best investment option. And I can tell you personally about me. My son, when he was 1 year, I started his SIP. And today, after 14 years, I've accumulated so much funds that he can go abroad and study. SIP, nothing can beat SIP as of now. So lump sum is very, very risky because, people... normally, I think Indian perception, there's this philosophy of fear, greed, and then, hope. First, they would have fear when then when the market is going up, it went to 21K, there was a greed. No, that time we were telling people not to invest, they were investing at 21K. Then market started falling down. So they were hoping, no, this is a temporary correction, ho jayega, it's okay. And then when it came to 7.5, 8.5, wherever, there was no hope and they sold. Let's not be in the market. And that was the right time. It went all wrong. They should have bought at that time and sold at that time. And if had they been in SIP, we knew people who were in SIP throughout that period, and they have done remarkably well.
So before we run out of time and wrap up the show, I want each of you to give our audience and to the people who are watching at home one thumb rule, one piece of advice that you think holds everybody in good stead when it comes to investing. What would that be?
So I think you should choose your advisor very properly, very carefully. If you have a right advisor who's giving the right asset allocation for you, I think 75% of your problems are solved, because he will select the fund manager for you. He will select the particular type of sector where you should go, and the most tax efficient and efficient way to invest. I think that's the starting point.
Redika?
I guess, I feel there's a lot of uncertainty outside in the global world. So no one can tell you for sure what's going to happen. But be very sure from inside. Whenever you are investing anywhere, be very confident. Take a decision, take a very informed decision and then go with it. And then don't go and discuss about it, Because I've seen when 4 people or 5 people, they sit together, everyone have their own view. Someone would say, this is going to do well, this is. So as he rightly pointed out, you have to have a good financial advisor. But even if you don't want to do that, you can educate yourself by watching a show like this one. But don't have an averse that mutual funds are bad or this is bad. You have to have a combination of everything.
Yeah, so basically if you're sick, go to a good doctor.
Yeah.
Problems are solved.
Yeah.
All right, on that note, it's time for us to wrap up the show. Remember, like I keep saying, you can get in touch with us. You can join us in the studio or you can tweet out a question. It will be our pleasure to hear from you. Renuka and Sanjay, thank you so much for spending time with us and answering our questions. Thank you, audience, for coming in. You've been a lovely audience. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का. Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.